You're going to get 17 times more shares of stock buying gold today and waiting for this to happen again. And it's probably going to be much larger this time because of this massive amount of stored energy. Hi, this is Mike Maloney, and I've got a chart here from Tavi Costa of Crescat Capital. And actually the chart, though, is from Incrementum. So that would be Ronnie Stoffele, my friend from Incrementum AG. Now, and they produce the We Trust in Gold. In Gold, sorry, the In Gold We Trust report. And this is the stock market using the S&P 500 as a proxy. Gold divided by the S&P 500. Now, I've been showing this chart or charts very similar to it. The Dow and the gold, if you look at Chapter 3 of the Great Gold and Silver Rush of the 21st Century, which is available for free, and it's an easy, fun chapter, and anybody that looks at a chart should read that chapter. It will benefit you for the rest of your life. So go to ggsr21.com and read that. It's a short chapter. It's fun. It's entertaining. You will enjoy it. It's not going to be... Chapter 4 is the most difficult chapter in the book. That's also free online, and that one is going to be modified. That's the reason it's online, is because I knew it was probably going to change rapidly. Anyway, so back to this chart of gold versus the stock market. So this is gold divided by the S&P 500. And what it shows you when it's below the line, when it's toward the bottom, stock market is overvalued, gold is undervalued. When it's toward the top, gold is overvalued and the stock market is undervalued. Now, I just want to point out that I've been measuring things like this for a long time. In my first book, which was written from 2005 through 2007, I basically showed everything that you're seeing here. And this part of the book was written in 2006. I've got the Dow measured in dollars, and then I've got the price of gold measured in dollars. Then I have the Dow. Now, the S&P and the Dow are almost identical. When you measure them over 100 years, the correlation is very, very high. They're almost, so either one can be used as a proxy for the stock market. So here's the Dow measured in dollars back when the book was released, and then the Dow measured in gold, and the Dow measured in commodities, and the Dow measured in agricultural products, and the Dow measured in crude oil, the Dow measured in industrial metals, and then the performance of the Dow measured as a percentage of gains or losses, and gold measured in a percentage of gains and losses, measured in dollars now, and silver measured in a percentage of gains or losses over that period of time. So this is something that I've been doing for quite a while, and this is an updated look at it with this chart from Incrementum, and I really do appreciate it. But I realize these new things, like all the stored up energy from going from a fixed, more free market monetary system to a centrally planned and controlled fiat currency system that causes these gigantic bubbles and the disequilibria, everything going out of balance. And then once every several decades, it tries to snap back and tries to go into balance, and it overshoots, and you end up with these enormous gains. So if you take a look at this, it looks like there's a natural balance, an equilibrium, where an ounce of gold would buy you about 2.5 shares, so 2.5 times whatever the points are on the S&P 500. I like to use the Dow Gold ratio because this oftentimes gives you partial numbers, like I believe it's at 0.49 or 48 right now, where the Dow Gold ratio always gives you whole numbers, and people understand whole numbers better than they do fractions like that. But so this was a natural balance under a much more fixed monetary system, under gold. there was this balance between the stock market and the value of the stock market and the value of gold. And so what you see here, the creation of the Federal Reserve happened back in here, and we did a bunch of deficit spending and expanded the currency supply for World War I. And then when the war ended, there was a big deflation called the Depression of 1921. That's this. But then you had these very expansionary policies in things called like bankers' acceptances and other things. There was stuff the Federal Reserve governed, and the Federal Reserve was too loose with their monetary policy. And there was also stuff that was more done just by the banking sector. But there was a big expansion in the currency supply when you include, you've got to watch my video on the crash of 29 and the Great Depression. There's a bunch of quotes there from Murray Rothbard, Ben Bernanke, and Milton Friedman that back up any of these claims. But what you saw was this expansion that did not cause retail inflation. It caused asset inflation. Well, what has happened for most of this century in the United States? We've had this big inflation in the stock market and in real estate prices and some other assets, but we haven't seen a lot of retail inflation until the government started sending checks directly to the U.S. population. And so it wasn't until after COVID that we finally saw the retail inflation of the expansion of the currency supply always causes inflation somewhere. It can inflate savings, it can inflate the stock markets, it can inflate real estate, or it can inflate commodities and retail prices. And we are going to be seeing that shift because even though the currency supply is currently contracting, there has been so much created that as some of that leaks out, it's going to cause commodities, so food and energy and so on, to rise along with gold. So whenever this is high, that's gold overvalued and stocks undervalued. Whenever it's low, it's stocks overvalued and gold undervalued. And once we went on to this fiat currency system, you see it go out of equilibrium. You've got the roaring 20s and asset prices soaring, and gold is fixed. And then you've got the crash of 29 and the banking crisis, and then gold is... the dollar is devalued against gold, causing this to soar. And then you've got the deflation of the Great Depression, keeping this high. And then you've got the Bretton Woods system was passed here, but sort of took effect over here. And the constant creation of currency, but gold being fixed in price. It was $35 an ounce. And it stayed that price while we inflated the currency supply for the Korean War, for Vietnam, for Johnson's Great Society, and then Nixon takes us off of the Bretton Woods system, and the world goes on the global dollar standard. It wasn't just the U.S. dollar. The rest of the world was pegged to gold through the U.S. dollar. So when we severed the peg to gold with the U.S. dollar, we severed it for the entire world. And this is the stock market going sideways. The Dow hit its head on 1,000 points in 66, didn't break out until 82. So the stock market is basically going sideways from here to about here. This is all gold's spectacular move, making up for all of this suppression and currency creation. And then you have the currency creation spilling back over into the stock market, and gold hit its high now. Incrementum, the In Gold We Trust report, they always use the monthly average price for gold, which means that it's probably a ratio that you can be able to hit. It's something where you could, if you did invest at one of these points, you might be likely to, because you've got an entire month here, an entire month there, an entire month there, to be able to sell your position and go into stocks and realize these big gains, because when you're if you're in gold from here to here, you're making gains. If you're in stocks, you may as well flip this chart upside down, because from here to here is huge gains in stocks. Now, this is gold going from here. They've got it. It doesn't, on the monthlies, it doesn't even reach 700. It's in the high sixes. So now I'm going to show you on stock charts. It says that gold reached $873 an ounce in January of 1980. And so instead of, if we go back to this incrementum chart, if this is at 6 up here, and so you're a little less than 1 ounce of gold would buy almost 6 shares of the S&P 500. So an ounce of gold, the price of an ounce of gold was almost 6 times the price of the points on the S&P 500. Well, currently it's at like 0.49 or 0.48, something like that. And so if it went back to that equilibrium, that would be about 12 times gains if you are invested in gold now and it goes back up there. But I think it's going higher, simply because look at the amount of stored energy here, where it goes out of kilter and then makes up for it. Then the amount of stored energy here, where it goes out of kilter and then makes up for it. Now look at all of the years of stored energy that we've got under papering over it. This is just currency creation, and this is, we go from regular economics to Bernanke economics. We go from Keynesian economics to Bernankean economics, Bernankenomics, and massively papered over things. And so the energy that is stored in this being under the 2.5, so it's this, not this line. Ignore that line. That's the average as calculated by a spreadsheet of all this data. It's not the equilibrium under a fixed monetary system versus a phony baloney fiat currency system that can cause these massive bubbles and disequilibria, everything being out of balance. Balance is up here, and so when this overshoots, it's going to overshoot much higher, except if you want to know the maximum, you go to this where gold hit 873 instead of 600 and something, and you see that this was almost 8 times, and we're down at, 0.46. So let's take, I'm going to do a little calculation here. We have almost, we'll call it 7.75 divided by 0.46 equals 7. You're going to get 17 times more shares of stock buying gold today and waiting for this to happen again. And it's probably going to be much larger this time because of this massive amount of stored energy. So this is the reason that I buy gold and silver. I want to thank you for watching. If you got anything from this video, please consider us as your gold dealer. We'll see you next time.
Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway, where you can win 1-1-1. 1 1-ounce silver bar, 1 10-ounce silver bar, and 1 100-ounce silver bar. So enter today and win.